kind of guy who would let me go a full episode.
No,
yeah, you would.
I literally told you before the episode.
You were going to.
I was not. You're the guy. You were literally the guy that waited until the end of the episode to let me know I had something in my teeth.
Yeah, but I'm also the guy who edits it out, so you're welcome.
You don't edit it out from my teeth. Get out of here.
Honestly, this is why I can't talk to you.
Welcome back to the #1 financial literacy podcast in the world. This is The Higher Standard. Sitting in front of me is my partner in crime in the All Facts No Cap T that you can find on thspod.com, Christopher Nahibi. Selfish plug.
Yeah, there was a lot of plugging in there. And sitting across from me, my partner in time, the one, the only, the man, the myth, the legend, the king of quarter zips. Yeah. Cy Omar, everybody.
Quarter zips. I'll take that. And sitting behind the desk in the production suite, he's back. The Fighting Fijian. What's up, my guy?
Hello, everyone.
Yeah, Rajil. We got a lot to get into today, right? First, I think you want to get into what went on with the dot plot in the summary of economic projections in the FOMC. We're going to get into buying versus renting later in the show. And we're going to get into the unemployment rate. But you said that this episode is going to be a controversial one.
Probably our most controversial ever.
Oh, coming out. There you go.
And I prepared a statement in advance of it. Just to make sure.
It's a disclaimer?
This will be our absolutely the most controversial episode of the year. We're going to tell you some things that you don't like. Probably won't like. But you know what? That's okay.
We're here for it.
Yeah, we are here for it. At the end of it all, we're going to explicitly give you an idea of how to invest your money in a way that really makes a difference in your life. But first, the quote. I need to read this because I know people are already going to be angry.
Should I read it?
Yeah, go ahead.
You got okay. I'll read it on behalf of the squad.
Yeah.
All right.
All right.
I understand why people are angry. If you're under 40, you lived through zero rates, asset inflation, a housing boom you couldn't participate in, and now the highest mortgage rates in 2 decades. Feeling like the system was rigged against you isn't irrational. It's, what is it?
Come on, man. It's experiential.
I was going to say experimental. Look, I'm adopting you.
You gonna read my quotes? You better read them right, boy.
This episode is not about fairness. It's about adaptation. If you want moral outrage, Twitter has you covered. If you want agency, stay with us.
There you go. So Matt was just here. Matt was on the show. And
shout out to Matt.
Yeah, he was talking to us a little bit about just kind of how he feels about life in general and business. And I think a lot of people do that to us, largely because we do the show. And I think people open up to us in a way that they probably wouldn't open up normally to other people. And I will tell you that the large portion of my DMs, the resounding majority of them, are people who are concerned about their financial future. Some of them are doing it from a place of optimism, like I want to make more money. How do I do that? And some of them are doing it from a place of just like, hey, I need to make more money. I got problems. But at the end of the day, they all sound very similar. And I think that there's a false hope every time the Fed cuts rates. And people were saying this last rate cut, hey, Chris, why didn't we see the treasuries move the way we had the previous 2 rate cuts? And now that we've seen the dot plot come out, we've had some time to assimilate that. This from Chart of the Day via Instagram. Rajil, you ready, baby?
Oh, yeah.
The Federal Reserve still sees just 1 rate cut in 2026. That's a very different forecasting scenario than we just lived through. We just saw 3, right? Now we're saying 1 all of next year is possibly where we're going to wind up. Now, this could change because you're going to get a new FOMC head next year.
In May.
And for those of you going, well, Chris, this is a little repetitive from the last couple of shows. I'm tired of hearing about the FOMC. Bear with us. The tail end of the show is going to be very juicy, very moist.
Well, juicy and moist, both. Okay.
Yeah, it's going to be the enjoyable part of the meat.
Okay.
Yeah. Part you like.
Yeah, the ribeye.
The Hawaiian ribeye.
Hawaiian ribeye, yes.
All right. So the central bank's so-called dot plot, which anonymously shows 19 individual members' expectations, indicates a median estimated range of 3.4% for the federal funds rate at the end of 2026, a quarter point lower than it currently is today, between 3.5 to 3.75%. The forecast is the same from its projection from last quarter. So we all know the purple dot at the bottom is Myron, depending on how you say his name, Donald Trump's most recent appointee. But even if you exclude him, right, you really don't have a huge statistical outlier. They're kind of all in the same place. And more importantly, this is relatively the same as what we saw just last quarter, or last time they cut rates. So that seems to be a pretty consistent cadence of, look, there's not going to be as many rate cuts as we had this year next year. So that's why you saw the treasuries rise long term, is they know long term that you're not going to see a rate cutting cycle continue in perpetuity. Right?
Right.
Kind of towards the end of it.
Right. And I think that's the thing that confuses people the most, They have their favorite realtors that they follow, their favorite brokers that they might be following and listening to, right? And they're like, oh, we're getting a rate cut. So they're also expecting, okay, so maybe right around the corner in a couple months or in a month or so, might be able to refinance, my mortgage, or maybe I can afford that house that I've been looking to buy, right? And then the opposite happens. The 10-year treasury goes up, and then that means mortgage rates go up. So I think that's the part that really confuses everybody.
And there's also a whole entire section of the Twitter sphere, now X, that is like the doomers. They're either a stock market doomer or a housing market doomer. And I see people like Logan, who works for Housing Wire as their chief economist. And he has this 5-year forecast. And he's a great guy, smart. I really value his input. But he's always rosy on housing and sees everybody else as a doomer. I try not to be either one, but I try to see both perspectives for the show, because I think it's important that we have a lot of real estate agents and professionals who listen to the show. Mm-hmm. And we have a lot of people who are on the other side of the coin who don't really trust real estate agents and professionals. And I try to see it from all perspectives. And this next chart is really important. This is the housing grand Ponzi scheme chart, Regil. This one is common rhetoric you see on social media right now. It has people upset, a lot of people upset.
Okay.
There is a suggestion that the Fed has done all of this, the rate cutting that we just talked about, on purpose. And I would argue that this is correlation, not causation, and people tend to get confused by this. But this is a post where you have the Fed data shown, where you have two lines overlaying, right? You've got mortgage prices, or home prices rising higher in green lines, and then you've got the mortgage rates going down even lower. And they're basically saying that this is all manipulated by the FOMC. Mm-hmm. And this is the kind of thing that really bothers me a lot. Because people will go, okay, well, if the Fed's doing all these things, you see these dot plot coming out, and now you see all this, and well, if home prices are going up and rates are going down, and they're just driving the money into the hands of the wealthy, I'm like, okay, well, that's not what the Fed does.
No, right.
Right? If you saw the last press conference, Jerome Powell was pretty explicit. Yeah, the mortgage section, the mortgage space has got a problem. Mm-hmm. He's not saying I'm gonna fix that problem.
It's impossible for him to, right?
It's not his job.
It's not. I mean, okay, inflation. Part of inflation, housing, shelter is a part of his job, and he does need it to come down.
It's a small part.
It is a small part, right? Yes.
Employment, right? That's job number one.
Yes.
Job number two, stable prices.
Exactly.
Housing prices are a small component of his price. Now, you could argue that inflation is largely propped up by housing.
It is, and it has been, right? And it's the slowest to react, right?
Lagging.
It's very, very lagging. But this is the inflection point that we've been talking about for the greater portion of a year and a half, 2 years, that, okay, at some point in time, inflation is going to get to a point where it didn't reach their target mark of 2%, mm-hmm. but the job numbers are going to start to get pretty bad, right? Right. And they're going to signal that it's going to continue to be bad, and he's going to have to make a decision. Do I save the jobs, or do I continue to fight this battle of inflation?
And that was largely the conversation that we heard at the last FOMC meeting, and a lot of the thing that he kept going back to, saying, well, we haven't seen the unemployment from AI coming in.
Yes.
We're going to address all this. So that's foreshadowing the business, kids.
Yeah.
We haven't seen this large amount of layoffs, and unemployment is ticking up, 4.2%, 4.3%, 4.4%. And then we got a print recently at 4.6%.
Ouch.
But before we go there, let's go to the next chart, Regil. I think the more important chart to look at than this kind of conspiracy theory that you see on social media, and X is probably the biggest culprit of that. Instead, let's take a look at where the wealth is and why this matters more. Wealth by generation. This is the real imbalance. And this is something we talked about on the show, where we talked about there being a K-shaped economy moving forward. We probably all heard it. If you listen to the show and you're into finance, you probably heard it from somebody else. The middle class is getting shrunken out, right? And this chart kind of explains why. You got millennials, Gen X, baby boomers, and the silent era. Silent era being the oldest of the generation, right? But the silent era doesn't have anywhere near as much wealth as the baby boomers do, which holds the large majority of the wealth. Frankly, almost as much wealth as everybody else combined. You got Gen X right behind them with a good chunk, probably about half of what the baby boomers do. And the millennials with arguably the smallest chunk, or maybe just incrementally more than the silent and early era, which is the oldest generation there. So the wealth disparity is pretty wide by generation.
Pretty wide by generation. And if you really think about it too, think about like what the millennials have had to go through in their adulthood so far to get to this point.
Yeah,
right?
Well, and think about it too. the baby boomers got the cheapest ability to buy. Now, they would argue, I lived through the 1970s. It was different. Okay, yeah, fine, whatever, bro. Yeah.
It ain't the same, bro.
Last 20 years have really changed the dynamic. So the silent early generation were part of that save and retire generation. And we're going to get into that and why that theory no longer works in a little bit. But
a lot of pensions were being handed out back then.
A lot of pensions. A lot of people had assets. They had to sell those assets to survive in a highly inflationary economy. So they've lost their wealth at the top. The baby boomers have maintained their assets. They kept their assets through this, and their assets started appreciating with crazy numbers. Crazy numbers. As a matter of fact, if you had assets and you're asset rich, you are far wealthier in most cases than you are if you had high salaries.
Yeah.
If you just held those assets and managed to keep them, even though your salaries weren't like super high, you got rich. That is not the same for Americans today because you can't afford to buy the assets to start that conversation.
Yep, it's true.
That is not fair. That is why you have an entire cohort in Gen X and millennials that feel like it's really hard to buy a home. And that's true because the average home age now of a buyer, the average age of a home buyer is 40 years old.
That's insane.
Yeah.
You know, that feels like the system has let you down.
You're not even 40 yet, are you?
July, man. In July.
Hey, Reggie.
Let me tell you right now.
Where's the party at?
Yeah, it is.
Where's the... Let me tell you right now. These knees feel like they're 40 years old. Tell you that much, bro.
No.
That much.
Let me tell you right now.
I played some ball last night. Oh,
wait, you played basketball last night?
I'm coaching, so I'm getting in and mixing it up with the kids. And
wait, you're picking on kids?
Have to. Yeah.
That's not right.
Gotta stay fresh, bro.
That's not right.
10-year-olds.
When I was your age, I used to be able to stop guys like me.
Yeah. Cut, move. Come on. I need you to cut.
Wow.
Yeah. But anyways.
I was fine on my knees until literally this year. 45 is when it hit me. Yeah. I hurt. They ache now. Like all those little injuries you have in your kid, they come back.
Yeah. I know the guys that I still see playing at this age and like at your age.
Why you got, come on, man. Why can't you say our age?
No,
our age.
Your age?
That's messed up, dude.
There's a lot of mobility work that goes in.
A lot of mobility
daily in order to be able to sustain that.
Oh yeah, I'm stretching. I'm getting down. I'm getting the squat stance. Yeah, I'm doing the whole thing, man.
Yeah, I'm seeing some of Adam's coaches and what they're doing, and I'm like, dude, forget it.
None of that since when I was a kid, I'm like, why are y'all stretching so much?
A lot of activating of the glutes and the hip flexors, and oh man, it's a lot. That seems like a lot of time.
I'm going to be the adult in the room because I'm the oldest, and not make a joke about activating your glutes. Okay, you're welcome. Because I'm the mature one here, Saeed.
Yeah, because you've had somebody at the gym literally tell you look like you need to activate your glutes. That's a true story. That's why he's laughing.
It's so sad because it's true.
Yeah.
Boomers didn't win because they're smarter. I want to be clear about this. If you feel smarter than that boomer who's got a higher net worth than you, it might be because you are. Okay. They won because they owned homes, they owned stock, they refinanced into 3% mortgages, and they locked in leverage before inflation. That's just time and circumstance. And I understand luck is the combination of preparation and opportunity.
Right.
They were prepared for the opportunity, so they got lucky. I'm not taking that away from them, but it's not the same today. The biggest wealth transfer of the last 40 years didn't come from innovation. It came from owning things when money got cheap. And homes are just one proxy for this. This goes for businesses in the economy and a lot of other things. But this is going to be a resounding theme of why we are going to deviate meaningfully from the investment advice you've heard historically. And this is all setting us up to get there towards the end of the show where we explain to you how to invest and why. You need to accept some of these things as fact.
Yeah, it's good. It's true.
But let's see why the sentiment is so dark right now and look at buying versus renting in America today. Because I think this is also an important fact that people have been saying this a lot on social media. There's a lot of anger around this. Everyone's like, it's cheaper to rent than it is to buy. And frankly, it's true.
It is, it is true. And I know that, some advice that we had back in the day that probably doesn't hold up as much anymore right now, at least where we live, right? You've notably said that you made the decision to ultimately buy once you realized that it was cheaper to buy than it was to rent.
That doesn't exist anymore.
Yeah, that's just not even sound advice anymore.
And mind you, when I did that, that was with like 3% down.
Yeah.
It wasn't like I put 20% down to do that.
Right.
It was 3% at the time. And I used some of my agent commission as a broker to put even more of it down.
Yeah. So let's go over just some basics real quick, right? So renting makes sense if you value flexibility, right? If you value the ability to be able to move around still, if you don't have any roots that you want to put down anywhere, right?
But you can't overlook that either. I think with a more transient work culture and remote work being way more prevalent, you're seeing just more humans value that level of transience, the ability to move around.
Mm-hmm.
And I think renting gives them like, hey, if I want to go live there, I can.
Right. Also, though, it makes more sense if buying stretches you out too thin financially, right? If coming from somebody like take it from me, if it gets to the point where now you have to limit the life experiences that your family gets to enjoy and appreciate, right? Then maybe this ain't it, right? Because now you're tied down to a home and you're grateful for the situation, but also it's like, okay, kids, sorry, we can't go on this trip, or we can maybe only do one trip if we're lucky, right? And you have to start picking and choosing. Okay, there's only so many activities that you can do. Like from a parent like me, I know that Carter is not into sports just yet. Not to say that he won't be.
Basketball on Saturday, we'll see.
Right? Okay, there you go. And I don't know about your boy Regil, but like if they get to the point where they take it seriously and they really, and they're like, Dad, I want to get better at this.
Yeah,
dude, the personal training alone is wildly expensive, and it sucks royally to have to tell them like, look, I can't get you that trainer. Right. And luckily for my kids, like, okay, I'm going to do the research. I'm going to get out there with you and I'm going to train you and we'll do our best. Not a lot of parents have that flexibility. So you're going to have to start picking and choosing. So if it stretches you out too thin financially, maybe it does make more sense for you to rent just so you got to still experience life. You know what I mean?
Yeah. And I think that's what people are feeling right now. I think that's the cultural divide that we're seeing is people don't feel like they're experiencing life because they just feel so cash constrained. There was an interesting article I read today about a woman in the Midwest. I can't remember what she did for a living, but I want to say it was like something clerical but like adjacent in nursing. But she made like $135,000 a year. And she said that like a couple of years ago, that was more than enough to her to experience life and do the things that she wanted to do for her and her daughter. She was a single mom. And now she can't.
Well, we talked about it. That 140,000 was that new poverty line.
That's right. And she felt that way, which to her was stunning because if you think about it from her perspective, she didn't make less money. Nothing changed for her, but everything changed for her.
Absolutely. I mean, if you look at, so tomorrow, the date is the 17th, 18th, CPI numbers are supposed to come out. Okay. If they're going to come out and they're going to give you the inflation rate, that's not what the true inflation rate is, right?
No, that's the average of everything in aggregate.
Well, they're also not measuring prices of things, right? It's what is the cost of maintaining the current lifestyle that you have. So if meat got too expensive, what's an alternative to meat that you might buy? And that's how they base everything off of. So the real rate of inflation is probably closer to 6%. So if you're not getting a 6% raise from your job, you're essentially getting a pay cut and you're accepting a lower standard of living.
Yeah.
Right. And I'm telling you, and that's most of us. Most of us are not going to get that 6% raise. Right. So that's just fact, right? So I feel her, and that's probably the sentiment most people carry.
So to your point, the reasons that people feel crushed in this economy, particularly when it comes to renting and housing in general, sticker shock meets immobility. High prices, high rates, low inventory, locked in, homeowners won't sell. People feel stuck, not just priced out. They feel physically stuck. And these cultural changes are meaningful. We don't quantify them enough because we don't want to look at how people feel because we as a society generally don't talk about this as openly as we probably should. But those are great indicators of what we are all experiencing financially. Number two, renting no longer feels like a temporary phase. Rents rose with home prices. No saving fast enough can escape that hatch, okay? And renting feels like a permanent displacement now. So now people feel stuck permanently. That's a problem. Now you have an entirely different human behavioral, dynamic where if people feel stuck permanently, they look for alternatives. They start demonizing the thing that they cannot get because they feel like they're never going to get it.
Yeah.
And that leads us to number three, expectation whiplash. Everyone was told rates will fall, housing will correct. Neither happened meaningfully. In the last rate cut of the FOMC, which is the cost of banks to borrow, not the mortgage rates, you saw the 10-year treasury rise, which pushed mortgage rates up.
Right. And what's the famous quote that the realtors and brokers like to say? Marry the home, date the rate.
Yeah, date the rate, marry the home. Yeah.
Yeah. No, doesn't always work like that.
No, and it certainly didn't work. If you bought a home in like the last year or so, and you put like a limited amount of money down, and 53% of the homes across the country have lost value, not a massive amount of value, but lost value, you could be not doing so well from an equity perspective. Now, that doesn't impact you as long as you can afford to pay your mortgage payment. It's not detrimental. It's not crisis territory. I want to ring any alarms.
Right.
But that's the beginning of what could be a bad trend for some people.
Yeah. I mean, for a lot of people, I want to be careful and not go too far down this rabbit hole and sound like the Grant Cardones and the Cody Sanchez's of like, don't ever buy a home. It's a waste of your time and your money, you know, this and that. But it's like, you got to factor in, there are hidden costs to owning a home. And like,
Grant Cardone had a really good post not too long ago that I commented on, and don't pull it up for Jill, so I don't even waste your time.
Yeah.
I don't want to endorse him. Yeah. But he actually he was talking about a $40 million home, so grain of salt. Okay, the cost.
I think I saw this, the property taxes.
Yeah, and he was talking about property taxes, maintenance, and all sorts of stuff that he was going into it with. And he was talking about, look, my equity over time in the next couple of years won't be anywhere near where that money could be in the market. So he probably made a little bit more fiscal sense in this economic climate. It's the first time I've heard him say anything that I was like, oh, okay, well, this kind of was true now. Mm-hmm. But I would also say that's also wildly confused because most people who are buying, let's say, the average home at about $440,000 in America today, they're not putting down 10%, or 20%. Mm-hmm. They're probably putting down close to 3 to 5%. Mm-hmm. Okay, that money working in a different area is not the same as Grant Cardone's down payment on a $40 million home working in his favor.
Right, and you think about it's going to take, like, the rule of thumb used to be stay in the home for a minimum of 5 years in order for you to start seeing some.
Well, Americans are staying longer now, so that rule's out the window.
Well, you're forced to have to stay longer now, but with the rates even being a little bit higher than what they were before, that number's probably closer to 7 years now.
7 to 8, actually.
7 to 8, right? So, the naysayers to buying a home are always going to say, it's a cheap savings account to buy a home. Like all the money that you put into maintaining the home, the property taxes, the insurance, right? Like you could have taken that money and invested into the market or invested into, Cody Sanchez says, buy a business that, like, okay, that might not be.
Can I go on the record for something real quick? Can I just get on my chest?
I feel like this has been on the record, but you can go on the record again.
I don't like her.
Neither do I.
In any way, shape, or form.
Yeah.
It's not that she's. I just don't like her face. Okay, I don't mean that in a hurtful way. Like I don't mean that in a bad way. Like she seems like a nice lady, I guess, but I change it.
Yeah, change it. Yeah, I don't like the demeanor. Yeah.
Maybe that's what it is. Maybe it's the ego. It's just something about her face.
The confidence is crazy.
It's such false confidence too.
It's because it's the Goldman Sachs, right? That's where she worked
for like 2 weeks.
I mean, a little bit more than 2 weeks.
Her resume is...
Nobody take that seriously, but yeah.
No, her resume is not real.
Right.
As a matter of fact, I would invite her on the show at any point in time. Let's talk about your resume, shall we?
Something tells me she's not coming on the show.
I declare shenanigans. Yeah, her and Dave Ramsey are not on the waiting list. Let me tell you right now.
Look, I've said this in maybe in a different lifetime, right? I wish that I would have taken more risk earlier in life and looked to start a business, right? And looked to fail and start again. And because, that part of it is nice, but like telling.
You unknowingly just walked into something that we're going to talk a lot about in a little bit.
Did I? I mean, I've been doing this for quite some time, bro.
No. I know you didn't read the show notes, bro. I know you didn't.
I did. That's the alley.
No, it's not.
You can oop it.
All right, look. There's a lot of things we wish we knew when we were younger that we heard or we thought about, but we didn't do because we followed what we thought was smart. Right? Health and nutrition are a great proxy for this. Carbs are bad. Now carbs are good. Mm-hmm. Fat's bad. Now fat's good. Don't eat this. Don't eat that. Go for running. Running was huge. 80s and 90s, baby. Go for a run. Now it's like, oh, don't damage your knees. Go for a walk.
Yeah, go for a walk. Exactly.
It's like, but when it comes to investment philosophy, we haven't really changed. And that's what we're going to do tonight, is we're going to change the way we all think about investments. And Saeed, just full disclosure, everybody, he's going to poop himself a little bit during this episode, so he might have to get up and go away. So I'll be prepared for you. So when you do, Regil, when he gets up and leaves, we'll just keep it going because he's going to need to poop himself for a little bit.
I don't think so. Just
make sure
we'll see. I'll be ready.
Tushy.
Yeah, we got the Tushy.
Yeah, sponsored by Tushy.
Yeah.
So let's bring up the buying versus renting in America chart real quick, Regil. So this is the chart, and this chart is meaningful. If you're driving, shame on you. But if you are driving and you want me to give you a oral depiction, that's what I'm here for. Mm-hmm. You'll see that during recessionary economies, the blue shaded vertical lines, you generally get the cost of buy increasing afterward. And it's pretty self-explanatory. What happens? People start buying more during these times because values come down a little bit, right? Mm-hmm. So then it drives prices up. And you've seen these peaks and valleys over time, and it's been a really fascinating rise. But cost to rent versus cost to buy has gone up at very different cadences. As a matter of fact, I would say that the cost to rent has just steadily gone up over time. You've seen a spike in 2022, and 2022 is going to be a very interesting year. I want to come back to 2022, okay? 2022 has been a very interesting year because you saw probably what I think is clearly the most aggressive spike in rental costs year over year in American history.
Okay.
Fair statement?
Yeah.
Based on the chart.
Fair.
Okay. You also saw at 2022 what is clearly, no argument about it, the single largest increase in cost to buy in American history.
Yep.
Those two things are facts, right?
Facts.
Rent went up, cost to buy went up, cost to buy went up way higher than cost to rent did.
Mm-hmm.
But again, all in 2022.
Yeah.
And I know what everyone's thinking, well, Chris, pandemic, stimulus. No. Daddy's got better answers for you tonight.
Yeah, I want better answers than that.
Okay.
I need something a little bit more.
Oh, don't worry.
And by the way, the source for this is Case-Shiller and the BLS.
Yeah, not a bad source.
Yeah.
I'm just saying.
Right.
So I want to apologize in advance to all the Twitter economists because where humanity and perspective creep in these conversations, it starts to change the paradigm. You can look at this straight from a data perspective, but you need to be human about this. Okay. You need to start thinking about this from how people feel. And I know that's not tactile enough for some people, but the Twitter economists can go cry themselves a river. Buying a home is no longer a lifestyle decision. It is a balance sheet decision. Do I want this for my balance sheet? We used to say buy a home because you need the utility. That's when it makes sense to buy.
That was our saying.
I still believe that. But I also think there is an entire group of Americans today who feel like they just need that on their balance sheet because they've been told their entire lives the single largest place that Americans derive their net worth is the equity appreciation in their home over time. I want that on my balance sheet to build wealth.
And I do think that it's also kind of ignoring that a lot of people feel the pressure, the peer pressure of buying a home just to keep up with, their friends or keep up with the other kids at school, right? A lot of people feel that.
Yeah, no, and I get it. It's almost like a point of shame for some people.
For some people, right? Or it's like, man, I want to start a family. They have visions of owning a home, having a backyard and doing all these things.
Fence,
Huh?
Having a white picket fence.
Having a white picket fence, all that, right?
Yeah.
So,
who really has one of those anymore, by the way?
Not in our community.
Yeah.
I mean, Sai lives in a palazzo, so different story. He's got a whole big fence thing going around his house. Regil and I mean, we're borderline homeless compared to you.
It's not true.
That's true.
Not true.
Yeah.
Regil, you can come over. I'm going to invite you over so you can see how small this palazzo is.
Yeah, all I'm saying is take your square footage, lay it out into one single level, and then add a huge lot to it, and you would have Saeed's house.
That's not true.
That's true.
That's nice, man.
It is nice. Congratulations,
Hey,
Saeed.
you don't act like you don't know this guy.
He's in my palazzo. It's very nice.
He's painting a completely different picture.
It's
It's 1,900 square feet, man.
Is it not a single family detached house?
It is a detached
You
house.
win.
Christopher, we've gone down this path. This is a dangerous game for you. How many detached homes do you own?
That's the question.
That's the
The question is, do you live in one?
I got it.
Okay.
All right.
So here is the harsh truth for many households, okay? This is going to offend a lot of people, but unfortunately, this is a perspective shift we all need to accept. Number one, renting is, in fact, cheaper monthly.
Mm.
That's it.
I agree.
Yeah, all in for sure.
By the way, Regil, if you didn't agree, there would be a very big argument right now on the show.
Oh, no, I agree. I mean,
Yeah. Get out!
Get out!
my rent is like a mortgage by itself. But
Yeah.
So, the interest and all this other things.
Yeah, but then
Insurance.
just think about the maintenance. What's the
Right.
cost? What's
Maintenance.
rental
Regil
insurance?
has a problem. He calls the property manager. They come fix it.
They come fix it. Yeah, bro, you better call them for everything. Hey, one of your light bulbs are out. Come up here.
I used to do that all the time.
Oh, you have to. Yeah, I'm not paying for this.
Like, hey, man, toilet smells weird. Can't smell it. That wasn't me. That's the water. It's
Yeah,
polluted.
Yeah.
All right, number two, okay? And this is going to be harsh for a lot of people. Buying is only rational if you expect long tenure in the property and the location,
Right.
right? You value inflation hedging. Not all people do, and certainly some people don't feel like a home is a hedge against inflation.
What do you mean by that?
Right. If you think that the home value is going to go up commensurate with inflation, or like we've seen in the last couple of years that it's going to rise outsized relative to inflation, because home value has gone up way higher than the average inflation number, no matter what the real number is.
Mm-hmm.
Right. Then you go, okay, maybe this is a speculative investment for me, but that's not a decision for most people. Most people are just trying to find a place to live.
Yes.
Right. Number three, you can absorb volatility. And that's an important thing. Homes are liquid investments.
Mm-hmm.
You put your money into that and you hope to get equity appreciation. over time, that long tenure becomes important.
Mm-hmm.
But it can also strap you in. And then, hey, if home values go the other way,
You're right. I mean,
you got an economic loss.
You're looking at it right now. I mean, in some markets, some neighborhoods, definitely still a seller's market, right? But in a lot of them, it's a buyer's market, right? We covered the data points on, I think, last week's episode with how many more buyers or how many more sellers there are than buyers, and I can't remember the data point off the top of my head, but it's pretty astonishing. And it's like homes are staying online for a lot longer.
That's right.
So to your point, yeah, they are illiquid, and if you need to get out of it, I think that now more than ever, it's going to be equally as important to maybe not put all of your funds down as a down payment. Maybe hold on to some PMI for a little bit longer, just so you can still have an emergency fund, right? It might be worth it. It might be a trade-off that you should want to consider.
I would say be more cautious of downside risk in home values in the near term.
Mm-hmm.
If you're going to be there for 5-7 years, then do whatever you want. But
if you feel comfortable, right? If you got stable income and you feel good, yeah.
So home ownership nuances that everybody should accept at this point in time. Home ownership is clearly not the only path to wealth anymore. It used to be, and it was the largest, number one source for most Americans. I don't think that's going to be the case in the future, and I don't think it's the case now.
Yeah, but I think it's not going to be the case unintentionally, though.
No.
People are going to be forced into other avenues.
They already are.
Yeah,
not going to be. They already are, number one.
Yeah.
They just accept that. Okay. And number two, but this is still most politically protected. Home ownership is a politically protected right because the Constitution, life, liberty, pursuit of happiness really meant property ownership.
Mm-hmm.
Back then it was farms, but really land and homes. That's what they're talking about there. So there is a political zeitgeist element to, protecting this asset class, which some people may or may not find useful. But look, it's changed. We all need to accept that it's changed. And the old school narrative that we were fortunate enough to adopt doesn't mean that's the only narrative. As a matter of fact, I think it's probably a losing narrative in the coming 10 or 20 years. And the answer and the conclusion has been staring right in our faces for a long time, and it has to do with technology. I have one more foundational element to set before we get into the why you need to invest differently and think very different about investing. And this is going to be as revolutionary as keto was when it came out. Like, oh my God, I can lose all this weight by just eating fat.
All right.
You can get rich by doing something completely different.
Let's go.
And it's gonna be a very obvious switch to some.
That's the title of the show. You can get rich by doing this.
This is true.
Mm-hmm.
I believe it fundamentally.
Mm-hmm. I'm already plugged in. Let's go.
Okay. Well, Saeed hasn't read the show notes, so he doesn't know that it's just
it's all I have.
Loaning money to friends. Hi, Saeed. I'm your friend. We would be remiss if we did not acknowledge that 4.6% is the new unemployment rate. It went up.
Mm-hmm.
4.2, 4.3, 4.4, and now 4.6. 4.6 unemployment rate, according to Yahoo Finance via Instagram, is very serious. There has not been a time since the 1980s, and the 1980s recession was the only exception, that unemployment was high throughout the 1970s and the last decade and economically. But let's get to the point here. There's not been a time that unemployment has been this high, and it did not indicate the early days of a declared recession.
Mm-hmm.
I am not being a doomer. That is just a statistical fact historically. Now, obviously, you can point to AI. You can point to some other things. Regil's kind enough to pull up the U.S. employment rate here. You got September, August, July, going all the way back, 4.2, 4.3, 4.4 from July, August, September, respectively. So, yes, this has gone up every single month.
Mm-hmm.
2026 is going to be an economic slowdown. I think we can all agree on that.
That's a fact.
Okay? This is a near certainty. And I can pretty confidently predict that most pundits are wrong. And it will not be boom times. You're not going to get people in the market. You're going to get the talking head on CNBC going, hey, Bob, I think next year is going to be a 15% increase in everything.
Mm-hmm.
And it's going to be prosperous for everybody, and it's just going to be amazing. Okay, I don't believe that. I'm sorry. I don't. I don't know where people get that weird fallacy in their head locked up from. Like, it just seems almost like buying into the narrative to sell the narrative to other people in the narrative. It's weird.
Right. And executives of publicly traded institutions right now are even expecting slower growth for next year. I mean, this is evidenced in the Challenger report. I want to let you finish too, but I got a whole thing on that and why. And the Challenger report is actually something that I think we should begin covering a lot more, especially with where we're at right now, and because it really gets into layoffs, right?
Yeah, I like the Challenger report. I think it's a good span and pull of some very important people.
Well,
in
it goes.
the
It
economy.
literally takes their data from the public announcements from corporations, right, and what's actually being announced that's going to happen, right? They're not. It's not on surveys. It's not on estimates. It's what's already been announced, and that's what it takes from it,
Why don't we
right?
cover it during an episode?
Huh?
We cover it.
We
During
could
an
we
episode.
cover it, yeah, but I think it's something because
No, why don't we do like a full breakdown of like? The
Oh,
next,
yeah, we should. So, but from this one, just to, high level, from January to November of this year, job cuts are up 54% year over year. Okay.
Wow.
The top 4 reasons companies are cutting jobs, and maybe you can elaborate a little bit on this.
AI,
Yeah, that's definitely on there. Number 1, restructuring,
which is code for AI.
which is code for AI, right? In November alone, it led all reasons. So think about store units or departments that are actually closing, right? Number 2 on the list, artificial intelligence. AI is responsible for 54,000 layoff plans. Number 3, market and economic conditions. So
Also AI.
also has a lot to do with AI. And the last one, which actually remains the leading reason for job cut announcements in all of 2025, with 293,000 job cuts.
Government. Yeah. I was going to put a chart in here about the government cutting jobs. That's the crazy part, is that we've seen a lot of cuts in the government.
Yeah.
And employees. And I don't know how. Okay, this is going to sound terrible, and I'm just going to ask the question, the quiet part out loud that everybody's asking.
Yeah.
Government agencies weren't known for
So
moving.
many, I had so many jokes that I refrained myself.
Yeah, pull back here.
Yeah.
Yeah.
Think Robin Williams.
Yeah. Pull back. You don't want to be that guy.
Yeah.
You want to be the comedian who's wholesome and
Yeah.
family love, but you can go to your comedy specials
yeah.
where you do the arm thing.
Nate Bargatze. Yeah. I'll be that. I'll be him.
Yeah, all right. Well, fine. So, the government agencies were not exactly known for efficiency to begin with. There were a lot of people not being efficient together. I have to believe that a lot of people not being efficient together is probably more efficient than less people being less efficient together.
I think I would agree to that. Yeah. I completely agree.
What
What has been implemented to make these
That's the question.
Yeah, what
That's
has
the
been
question.
right?
Like, no one has come out and been like, okay, listen, this is how we improved efficiency.
Right.
in
We
this
let all these
business.
people go because they're no longer needed.
Like, shouldn't you improve efficiency first and then let them go?
Right. Yeah, exactly. Look, we've created this technology that'll make it more efficient. Now we no longer need you.
Maybe I got it.
Mm.
Department of Government Efficiency.
Yeah.
Doge forgot the whole being efficient first part of it.
There you
before
go.
you started cutting
Before-
jobs.
You think that's what it was? Okay.
Yeah.
Yeah. So the other reason why I really like this report and why it's, I think, good for our listeners to pay attention to, and why we should routinely cover it, it dives into the industries that are being impacted, right?
Mhm.
So you can get a feel for, okay, is this coming up in my industry, or is this like what's going on mainly like in tech or finance, or what is it? So for this report that came out, it was mainly telecommunications, right? Technology, the service sector, and retail. So
I
that's
saw a similar quote on construction too. Construction
Mhm.
industry is booming a little bit from the employee standpoint.
okay. Yeah.
But well, let's finish the thought on employment, because we want to get to the meat and potatoes. And the meat and potatoes is our new investment philosophy.
I'm ready to adopt it.
That's the meat. These are the
I could use a
You
new.
don't say that now.
I can use a new investment philosophy.
Don't say that now, because you're gonna have to go to the bathroom
Okay.
halfway through. Okay.
Are you gonna adopt this investment philosophy,
I think so.
or have you already?
Full disclosure before we get there, and people are gonna be like, "Oh my god, I have."
I'm teasing.
No, I'm not. I know you're
I'm teasing that part, the meat and potatoes.
strange hand gesture. I have always been a believer in VIOO, the S&P 500 index funds. I think that belief is wrong now. I mean, I had it down to a philosophy we gave out on the show previously about where I invested. I don't think it's real anymore. I think it's outdated.
Mm.
I think it's, gone with the wind. And I'm going to explain why, but I think that's an early precursor. But
Interesting. Okay.
the U.S. labor market is coming to a halt. This from the Kobisi letter via X. The total non-farm hiring rate fell negative 0.2 percentage points in October to 3.2%, the lowest since 2020's pandemic bottom. Over the last 4 years, this figure has declined 1.4 percentage points to levels in line with December 2008. Meaningful time, also known as a great financial crisis.
Mm-hmm.
By comparison, during the 2001 recession, the hiring rate was much higher at 3.7% to 4%. And typically, unemployment spikes at the end of a declared recession,
Mm-hmm.
which is also an interesting thing that we're seeing now. If we're seeing unemployment begin to spike back up, and we're not in a declared recession, which typically is declared afterward anyway, it is normal to see unemployment spike at the end or towards the end of a recessionary period.
Right. I think 2010 we hit 10% unemployment rate. A year and a half, well past the recession.
That's right. So, furthermore, the private hiring rate fell to 3.5% in October, the lowest since January 2011, and in line with the 2020 lows. The U.S. labor market has frankly stalled, as Saeed has pointed out. Jill pulled up a beautiful chart here, which shows a bunch of lines going up and down.
This is like my heartbeat.
Yeah. Is that a heart attack in the middle?
That's what that was.
In 2020, the pandemic heart attack, we'll call that. All right, now, let's get into investment philosophy. Jill, you ready?
Let's do it.
You strapped in?
Oh, yeah.
Saeed?
Let's go. I'm ready.
Okay. I will say there is a whole segment on the loom as a proxy for what this is in a link that I provided in the show notes from Market in Moonshots called the Window Manifesto, about how the loom affected the textile industry. And it gives a very, very good similar analysis to what we're seeing today with AI. But before we get into this, I want to ask some simple questions to both of you.
Mm-hmm.
Do you two believe that technology is changing at an ever-increasing faster cadence?
Yes.
Jill? Okay. Do you two believe that the speed at innovation in general has increased?
Yeah.
Okay.
I think that's been the case, as old as time.
As old-
It's always increasing exponentially.
Okay. So let's take that and let's go with that for a second. Do you believe that we have now hit a point where it's faster now than ever before?
Yes.
Okay. Those three questions and those three answers are going to lead you to what you probably think is a strange conclusion for the future and how to invest your money. And you're going to say, well, Chris, that's concentrated, or that doesn't make sense to me. But first, let me tell you why the old ways don't work. For decades, the story was simple. When markets grew, the economy created jobs. When markets cooled, hiring slowed. Right now, we are not seeing that. The market has not effectively cooled, but yet we're seeing a massive slowdown in jobs and unemployment increase.
It's almost a tale of two different markets.
But we do know there is some weird behavior with the S&P 500 where the Mag 7 is leading the way. Yes?
Yes.
Correct.
Jill?
Yeah.
That's right.
Mm-hmm.
The booth is involved today.
Let's go.
Strap in, Jill. The two lines move together, intrinsically bound, both being a proxy for the same thing, economic prosperity. Then something broke. Something happened.
Uh-oh.
Regil's showing you the S&P 500 index versus total job openings. They moved largely in line.
In tandem, yeah.
And then look up, 2022, something broke.
What broke in 2022?
Remember when I said 2022 would come back to bite you in the bum?
Mm-hmm. And the bum? Yeah.
This is the bum.
Uh-oh.
It's biting. What happened on November 30th, 2022? Sai, do you know? Regil, do you know?
Has something to do with the Fed rate cuts or rate increases?
Oh, sugar bear. Something happened on November 30th, 2022. Since then, some of the Magnificent Seven stocks have almost tripled. Meanwhile, job openings, well, they're back to 2019 levels.
Pre-pandemic levels.
Pre-pandemic levels. Regil, pull up the next chart. Okay, this is a correlation chart. We don't talk about these much in the show. Instead of just showing S&P 500 versus total job openings, which typically move aligned with one another, up and down, the correlation chart is a bit different. It shows a very different tale. You can see that the black line above the X line, if you will, shows that these two things, the S&P and the jobs report, were very much aligned. They were very correlated up until November 30th, 2023. And you can see now that it started to go down, and now it's moved into the negative, where the correlation is completely divided.
Yeah.
So effectively, they were still moved somewhat in line, just at a wider cadence, up until about 2025, and now it's going negative, where they're not moving, they're moving in completely opposite directions.
Yes.
So something meaningful changed November 30th, 2022 that has driven this correlation completely apart.
I got it.
Mm,
OpenAI launched.
that's right.
Mm.
In his defense, he does have Google in front of him.
I do have Google.
So you had Jerome Powell in the last FOMC meeting saying that he hadn't seen it yet. The site hasn't appeared in the numbers.
Mm-hmm.
Yes, it has, Jerome.
Yeah, just not a data point that they say that they claim to use in their beige book.
Well, again, they're not looking at the correlation. They're looking at the chart. And unfortunately, when you look at the correlation here and just take the same data and overlay it, it looks very different.
Yeah.
But I know you could say, Chris, you're just taking numbers and you're pulling them out of Saeed's Tushy to use a Tushy and make a Tushy and all the Tushy stuff.
Mm-hmm.
Because we like Tushy stuff in the show.
Mm-hmm.
It is a lagging indicator, okay? I fully appreciate the gravitas of this being a number that we look at in retrospect. And maybe it's hard to have confidence in, but that's precisely why it matters, okay? Shorter time frames show noise. This shows how unusual sustained movements like this really are. Sustained negative correlation, if you want to be technical, really can be. So on the first chart, the line represents capital, ownership, and productive assets. The other line represents human labor, your ability to sell your time for skills and sell your time and skills for money. Okay?
It is essentially what you're doing.
That's what we're comparing. And I know it sounds terrible and esoteric and really just bastardizing humanity.
No, but if you boil it down to its simplest form, that's what it is.
Ownership of productive assets versus human labor, your ability to sell your time and skill for money. That's all we're comparing with these two charts. For your entire life, they move together, and now the gap is widening. That in and of itself should give us pause to think, okay, something meaningful has changed in the economy. Maybe the way I invest my money should change along with it.
Perhaps, yeah. Definitely.
We're not a perhaps show.
No, I want to hear more.
Okay.
Yeah. Because look, at the end of the day, had you continued to invest the same way that you had been, let's say, since 2022, you still would have turned a close to 20% profit.
Fire. Fire is the answer, Saeed.
That I'm fire?
No, not fired. Fired?
No, you said it. Bro, you're
Fire.
so fire, bro.
Fire. Nobody says that anymore. Just to be, we are a millennial appropriate show.
Yeah.
No one says that. So that was actually an acronym. It's short for financial independence, retire early. It's broken.
It's broken. Yeah, you're not retiring early.
Okay.
In
1992, Vicky Robin and Joe Dominguez published Your Money or Your Life, laying out a powerful new novel idea.
Mm-hmm.
If you can accumulate 25 times your annual expenses, you could safely withdraw 4% per year and never work again. God, that sounds amazing.
Okay, break that down to people.
Well, the concept simmered for years. Okay. And people were like, okay, wait, if I can accumulate 25 times my annual expenses, so I write down my annual expenses, let's say it's $1 million a year, and I accumulate $25 million a year for the rest of my life, I'm good. So I hit that target number, right? So I have financial independence, I can retire early.
Yeah.
Very simple concept, except it doesn't work anymore. It's broken. You can knock, no one's coming home. Okay?
Okay.
2010, Jacob Lund Fisker published Early Retirement Extreme, a series of retirement books. I like to call these the Jim Cramer fans.
Yeah.
And something clicked. By the mid-2010s, FIRE, Financial Independence, Retire Early, had become a movement, particularly among millennials watching their parents grind through decades of corporate life. Nobody wanted to do that. They wanted a way out. This gave them a grind early, then on the I can exit out, right? That's where hustle culture came from. That's where grind mentality
that's where it first started, right?
Started.
Yeah.
Right? Blogs proliferated, subreddits formed, software engineers making $150,000 a year, living on $40,000 and retiring at 35 instead of 65. This fired people's imaginations. Oh my God, Jill, you can retire by the time you're 35?
Game, I'm on. Let's go.
Got 1 year left, man.
Sign me up, homie.
Yeah. I'm all in for that.
Except that isn't real anymore. That don't work. Roommates in your 30s, used cars, cooking every meal, saying no to expensive hobbies. Surely not for everybody, but for those who did it, the reward was time. You got to live the back half of your life. Margaritas.
Or at least be able to maybe step away and focus on something that provides you a greater purpose and something that you're passionate about, right? Gives you the freedom to, because that idea of retiring early and just having time, yeah, okay, don't get me wrong. I do want to spend all the time in the world with my wife and kids. But I do also know that we, as human beings, we need a purpose, right?
Let the record show that Saeed is not always a good husband, Rajil.
What do you mean? Part of being a good husband is for me to, stay mentally sane. And
I wish I could spend every waking moment with my wife.
Yeah, and kids
and kid.
True story.
I have one, Saeed.
My daughter came home with a haircut today. My wife took her to get her haircut.
Very meaningful moment for women.
Yeah. It's been her first one in years.
How'd you feel?
She was excited.
Okay.
She stepped out the car, and I felt like, for a brief moment of time, it felt like time was passing by so slow as I'm waiting for her to get out of the car so I can see it. And my wife, the door, the windows tinted so I can't even see her walk through. And I swear to God, she stepped across, and I literally, you're gonna call me out for this, but I'm just opening up and being vulnerable on the show. I was bawling like
legit crying?
Like legit crying.
Were you doing like the chin wiggle thing?
No, it was just literally coming down, and I was just like, she looked so beautiful. She looked way older than she is. She's only 7,
Did she tell you what she was gonna do to her hair before she went?
Yeah, I knew that she was cutting it shorter, right? But she had really long, and I was just like, I almost got a glimpse into her as like an adult.
Oh God, I
dude,
don't know about you.
Dude,
I cannot wait to attend this dude's daughter's wedding.
Oh my God, bro! I don't know if I'm gonna be able to attend this wedding, dude. I'm gonna be in tears, but it was insane. So, anyways, but I do also know with that, as much time as I do want to spend with them, like we all need a purpose, right?
I agree. Yeah,
we all need something, like a problem to be solving. And although it's frustrating at times, like I know for you in this podcast,
has that gone too far? I mean, the podcast definitely has gone too far, just to answer your question. But has this gone too far as a society? Have we pushed like humanity needs a purpose, humanity needs to work so much? Like, look at Warren Buffett. Warren Buffett's retiring now. Dude's dead. Like he's alive, but he's not alive.
Dude, I saw some wild post the other day about the dividend check he gets from Coke.
Yeah,
it's crazy. Bro,
yeah. I was like, "What kind of Coke is he?" Oh, okay, yeah. Wow. I was like, "Hey, a minute, that didn't make any sense."
Coca-Cola.
Yeah, but it makes it's a weird life, and I'm asking these questions, one, to be sarcastic and funny, and if everybody listens to the show and goes, "Oh my God, Chris is way better than Saeed," but also because I think it's important. I think it's important to ask these questions because a lot of where we're going to come to the conclusion of this and how to invest comes down to you asking your question of like what you want your standard of life to be, and are you holding on to outdated ideals?
Okay,
I think we do. I think I do. You know,
I mean, maybe part of, and I want to hear the rest of this too, but perhaps maybe
because you're not getting a choice.
I'm not getting a choice. Some of this might maybe the idea of diversification isn't just your portfolio, but style of investing too. Right, like
that's a problem. Yeah,
right. Like maybe do a little bit of like old school mentality, right? Yeah. Like old school ideology, and then maybe adopt some of this new stuff that you're about to present to the peoples.
The peoples. So FIRE was aspirational, right? Mm-hmm. It was never about securing your retirement, but about lifestyle design and living a life on your own terms, which I completely agree with. FIRE adherence fundamentally relied on the same assumptions as traditional financial advice: the safe withdrawal rate of 4%. 7% returns, and the need to accumulate 25x your expenses. So in theory, it was you would get a minimum of 7% returns from the market. You would put out 4% every single year to maintain your life. And then guess what? 3% would continue to grow and compound over time, and you'd be set for the rest of your life.
You'd be set for the rest of your life.
Gummies and lollies for everybody.
Yeah.
Well, what happens when Bitcoin does 50% annually? Saeed.
Okay, but hold on, Christopher.
I can feel it clenching a little bit. You want to let it go, or you want to go now?
Okay, we're gonna acknowledge that, but you can't say that without also saying in the same breath that it's dipped 80% 3 times already.
Okay, hold on a second.
I'm just
Take
saying.
A deep breath. I know you're angry.
That's too much volatility for me.
All right, Rajil, Saeed has an issue, a chronic health issue we have to talk about. He has something known as wet paper towel hands. Okay.
Wait, you changed it to paper towel hands?
Wait,
paper towel. That's way worse than paper hands.
Would you prefer wet paper, toilet paper hands?
No, it can't be like college rule book paper. Like, why gotta be paper towel?
That's not what it is. Okay.
Paper towel hands.
Okay, let me ask the question a different way. What happens when the QQQ does 20%?
Well, that's an index that you got to invest in.
I can be even more pointed and
say, that's an index you should invest in.
Okay, we're gonna get to that, and I agree, but you could be even more pointed and say, well, what do you do when the Mag 7 or the Mag, the top 10 in the S&P 500 do 20%?
Well, that's my point. That's why you invest in the S&P 500 to cover your bases.
But does it? Or are the other 490 stocks pulling you down?
I mean, yes, of course, but there's no way to predict that, right?
But you just said to me to start this segment that innovation, you both agree to this, innovation is moving at a faster cadence. Technology is moving at a faster cadence. Why wouldn't you bet on the technology stocks leading the way and not bet on the non-technology stocks lagging you down?
Well, and that thought process right there is the exact reason why the Mag 7 is still continuing to outperform everything. People who are pulling their money out of the savings accounts, and those are the only stocks that they feel comfortable in investing in because they're all propping each other up.
Or maybe, just maybe, technology has changed, the cadence has changed, and these companies will be technology companies that are going to be the outsized growers in the market for the rest of time.
Oh, yeah. Yeah. And we've covered this on the show too. There was literally an article that came out from the White House, right? This isn't a political, like anything political. This is from the White House. They said I think it's called the winning race, right? Winning the race. And it is winning the race to get to AGI.
Just to be clear, not ethnicity.
Winning the race.
The race. The
race. Yeah, like
the attempt to get there before
like the marathon,
okay,
right? The sprint, right? The 100-meter dash.
Yeah.
Be careful, Christopher. Hey, stop dancing.
I just got to make sure certain lawsuits have been filed.
Yeah. Yeah, we got to clarify, right?
Yeah.
And it's like they've come out and said, like, we will go to any lengths to make sure we win that race. Okay.
Right.
So it's like, yeah, you're right.
That's sprint.
Sprint. Yeah, we will sprint.
I prefer that vernacular here.
Yeah. We will provide the jet fuel packs.
Yeah. Suddenly, the math of 25x in all these markets, right? If you're talking Bitcoin, QQQ, S&P 500, whatever it might be, right? 25x becomes disconnected from reality. You may only need about 10 to 15x, but FIRE fans often didn't like too much risk in the portfolio and followed the classic portfolio compositions like the fund portfolio or even the 60-40 mix. 60% stock, 40% bonds, equities to bonds, right?
Yeah.
Except that ain't paying the bills like it used to, bruh.
That is very, very, I guess, risk adverse.
You go to any iconic book. I was brought up on the 60-40. You should be 60% in equities and 40% in bonds. Bonds and equities used to form opposite one another, almost like that correlation chart. That doesn't happen anymore. As a matter of fact, there's a pretty significant disconnect on how those two interwork with one another, and it's caused problems. So let's talk about the other methodology here. Okay. It's very similar to FIRE, work, save, retire. Simple concept. Regil, would you like to work, save, and retire?
Yeah.
Syed, would you like to work, save, and retire?
Sounds glorious to me.
Sounds amazing, right? This advice was everywhere for the longest time. Work, save, retire, guys. Not that hard. And for decades, it worked. Except we know that it doesn't work anymore because people are working in perpetuity. And some people like it. I understand. Some people can't retire. Get a good job, save 10 to 15% of your income, max out your 401k, and get the employer match. Be consistent, Syed. Diversify with a 60-40 portfolio, 60% in stocks / equities, 40% in bonds. When stocks fall, bonds rise. So you should be good. You should be Gucci.
You should be Gucci, yeah.
As the kids say.
Gucci Mang.
Rebalance annually. It's simple. Just keep that percentage and you'll be fine. Just check on it every year, once a year. Not that hard. Buy and hold index funds. The S&P 500 returns about 7% real per year over the long term. Don't try to time the market. Don't pick individual stocks. Just own everything and let it compound for 30 years. I gave that advice on this show. I have hundreds of thousands of dollars, almost $1 million, frankly, in low-cost index funds, and now I feel like a jackass.
No, you shouldn't feel like a jackass.
I feel like a jackass.
No, because
I'm Chris. I'm a jackass. Hi, Regil. I'm Chris. I'm a jackass.
No,
hi, Chris.
That afforded you a lot of flexibility, and that shouldn't be shunned. Because I'm still gonna do that, and I'm still gonna teach my kids to do that. Right?
Okay. Well, that's because you've got wet paper towel hands.
Wet paper towel hands. Look, it's actually one of my favorite statistics, and I have it here actually for the next episode that we're gonna do because we're gonna go Drake back to back on them tonight. Right? But
he's been waiting to say that all night long.
Oh yeah, I'm just itching. I couldn't even wait to the next episode. I had to say it now.
Yeah.
Right? The market's biggest gains often occur in a few isolated days, usually clustered around periods of high volatility, right? And market stress, making them nearly impossible to predict and time correctly. A $10,000 investment in the S&P 500 in 1980 left untouched until the end of 2020 would take you up to $1 million, right? If you just remove the top 10 days of the performance of the S&P 500, you'd have less than $500,000.
I hear what you're saying.
10 days?
We've given that advice. I firmly believe that that's real. But is that expectation of a return too conservative? I understand you wore boat shoes when you were 14.
No, but my point is,
I understand conservative nature is part of your DNA.
I'm back to Chucks, though.
Yeah. Okay.
Yeah.
So think with a Chuck hat for a little bit, okay?
Okay.
With inflation being what it is in a single year, are those returns really keeping you above inflation, or do you need to take on more risk relative to the markets in order to sustain your lifestyle?
It should be a balance. There definitely needs to be a balance. This can't be your entire portfolio.
I have a proposed balance for you.
Because we've said this. But listen, this isn't all brand new. We've said this on the show too. Some of the richest people that we've seen and that we know, especially you, right, that have diversified their money.
Of all ethnicities and races, by the way. All of them. All of them.
All the races.
All inclusive.
Yeah.
All over the world.
All of them. The ones that have made it, I guess, further along and would, I guess, be deemed more successful have said it's been their speculative investments that made them the most money.
Yeah. Yeah. I would agree that.
So some of this is still speculative. There isn't enough time in this for us to say that it's proven. But I'm just saying it's still speculative, and like we've said on the show, you should dabble. I have people literally hitting me up now and telling me, like, close family members and friends.
Want to dabble with you?
You know these individuals.
What's up, Weiss?
No, somebody else. And they've said, dude, right now the market is in collectibles, right? It's either in sports memorabilia.
Bro, my wife has vintage jewelry.
Vintage jewelry. It's think like not even just like Pokemon cards. Like I guess Gary V has this thing where he's selling like characters and kids are going crazy over them. And
this has been for a while now.
Right, for a while, right? And this trend is really like popping off. And
it
kind
of runs in line with the whole analog, like retro throwback you're going to see in 2026.
Mm-hmm.
Yeah.
And it's actually, I mean, we could do a whole show on this, but like, look, that's still a speculative investment. And it might work, you know? Don't get me wrong. I got a lot of sports memorabilia that I might be banking off of in the future someday, right? But I plan on like passing that down and letting like the kids do whatever they want with it. I don't want to touch it, right? It has sentimental value to me. But it's still a speculative investment.
Okay. Well, the last thing you can't disagree with from the work, save, retire mindset and culture, something that has led us to the early parts of this conversation tonight. Get a 30-year mortgage and buy a home. You'll slowly climb the corporate ladder and pay it off. By 65, you'll have enough to retire comfortably and free of debt. This wasn't bad advice for people who started investing in 1980, 1990 even, or frankly, up to 2000. Okay? So not bad advice. It worked beautifully well.
If you were contrarian to this, you were saying like, look, the entire model was a whole marketing campaign to get people to buy into the American dream. And look, you have 300 million customers.
And this all worked until it didn't. And when it broke, one by one, things started to fall apart. And around this time, this podcast came about. Ironic. Maybe we broke the system.
I think we did. I like to take credit for that.
The 60-40 portfolio is dead. Stocks and bonds used to move in opposite directions. That was the entire point of having that makeup of your portfolio that you rebalanced annually. When stocks crashed in 2008, bonds rallied, cushioning the blow. But since COVID, the correlation's broken. In 2022, both stocks and bonds fell together. The hedging mechanism that justified holding 40% just vanished overnight. Regil, chart me, baby. There it is. There's your correlation chart again. The S&P 500 to the bond market. They rose and fell together. They were aligned until they weren't. And now you're seeing volatility since 2022 that you had not seen going as far back as 20 years.
It's wild, man.
Maybe even, frankly, farther than that. The last few years have produced two demonstrable winners. Tech stocks from the S&P 500, which we've covered on the show, the Mag 7 plus 3, 10, and Bitcoin. Pucker up, Saeed. It's go time.
It is. Yeah. Look, I'm not going to deny it. Look, it's factual. If some people came up on top for this, I commend you. Good job. Good for you. Right? So what are you going to do? Are you changing up the whole dynamic? You going crypto again?
I think so. But I have some very specific parameters for going crypto.
And this is just saying we got a sponsor for the show. No, I'm just kidding.
Yeah. Poly markets. If you like this, by the way, there is a sub stack that I'm gonna link in the show notes again, where a lot of this came from. I would love to say that this is a novel concept. I believe in what we're talking about now, but this is really the work of a gentleman. I think his last name is Lukowski or Lasowski or something. I can't remember, but the links are down in the notes. So just click there, and he does a really interesting proxy historically as well. I think it's valuable. But let's get comfortable with some facts, shall we say? And by let's, I mean you.
Okay.
Okay. We all need to face these facts together, but Saeed definitely more than all of us. Butter was bad and carbs were good. Now carbs are bad and butter is good. Don't eat bacon. Don't eat salt. It all changes. Shout out to Mind Pump.
And Rogan.
Yeah. They were good Samaritans for our show, and I thought that reference would resonate with a lot of fellow colleagues from the historical cadence that came from the show. They love us. We love them.
We do love them.
And we all love Adam.
Yeah. We love all of them.
And, well, the math has changed, as well as your health and fitness, frankly. The old investment advice assumed 7% returns in 30 years to accumulate, but things have changed. You don't know how much time you have. What if the number is 5? What if the number is 10? And I don't want to be dark and morbid, so we're going to move on. The market grows 10 to 20% a year, not 7.
Damn.
Almost 3 times as much, Saeed.
Yeah.
Your 60-40 conservative split.
Leaving money on the table.
Leaves money on the table. Broad market diversification thesis doesn't really hold up well. Diversified in the market. Okay, well, let's just use that S&P 500 example again, right? 490 stocks didn't do so great. 10 of them did spectacular.
Yeah.
Diversification was dragging you down, baby.
Okay, but I mean, I'll let you finish before bringing just
That's right.
A thought for somebody.
That's right. You hold those wet paper towel hands. Hold those wet paper towel hands as long as you can.
Keep them dry.
Yeah, keep them dry. Okay. Bitcoin crushes everything else year over year. Like that or not, that's kind of factual.
Mm-hmm. Yeah,
it's hurting you, isn't it?
No,
I know.
Look, at the end of the day, as long as there's belief in it from the masses, it's gonna continue to do well. And dude, there's so much hedge fund money behind it. It's probably not, they're not gonna let it go south.
Yes, but I'm also going to warn people about how to invest in this the right way, because I think the most likely solution is to take risk-adjacent approaches to this, and I don't think that's going to get the job done for you. So we'll get there as well.
Okay.
What does that mean?
No. I was going to say the Bitcoin ETF.
Yeah, don't do that.
Don't do that.
You got to hold it directly.
Yeah.
He's like, that's how I would have done it.
ETFs and index funds. That's my only way, bro.
Yeah. Share the risk. Yeah, no. Okay, so housing. Real estate prices go up fast, but demographics change and add question marks. We've seen some really weird things. But bonds, we know for sure, are negatively correlated with stocks. They're not doing that anymore. Okay, so that whole correlation is gone for the last couple of years. So things have changed pretty heavily from where we originally had investment concepts coming from, the same way health and fitness has. So let's take a different approach here. If you're a worker, invest in whatever assets you can, in the hardest assets you can access. That's right. Giggle. Get it out of the way.
Can't.
Continue until you don't have to rely on your work anymore. That's the concept. Invest in assets, because we saw from the older generational gaps, those who hold more assets by age demographic have more money.
Yes.
So the goal here is to hold as many assets as you can until such time as you don't have to work anymore.
If there's one resounding theme that I would love for our listeners to adopt, and something that, the cliche of, if I could go back and speak to my younger self, what would I do? And I've done a relatively decent job. I haven't been as bad as some other people that we know, but it's increase your investments before you increase your lifestyle, right?
Yeah.
Like, don't opt for the big car payment. You know what I mean?
It's 108 in the show, Regil. Saeed finally acknowledges having the palazzo.
No.
I get it. We know you're ambiguously talking about something else, not the palazzo. Fine. Keep going.
No. Jeez, man. But it's
what was the name of your house again? It has like a big fancy name, right?
Name. Yeah, the second home.
Yeah, it was
the beach house.
No, it was like Chateau something, whatever it was.
Oh no,
Miraval or whatever it was.
Yeah. You maybe lose my train of thought, but
you mean the one you were saying? I'll remind you what you were saying.
No, you should.
You were telling us about the palazzo that you had.
No, you should be increasing what you invest in, because at the end of the day, to your point, investing in assets it's going to ultimately help you way more in the long run. Now, look, at the end of the day, we will have to go down this path with our listeners at some point in 2026. We will be doing a lot more educational content that I think the listeners would like to have from us.
That's almost entirely ready to go at this point. It's just
a matter of us actually, getting to work on it. But okay, it's the same similar concept of, okay, I have a home that's appreciated and has received so much more equity, right?
Mhm.
I've increased my equity in it, but it means nothing to me because I'm not selling it, right?
Mhm.
So we're telling people to invest, right, in all these assets and watch them grow. But okay, how do I diversify it? How do I move it to eventually capitalize off of it? Are you telling me to only invest in stocks with dividends so I can receive some type of passive income? Like, what is it? So we will get into all that at a later time, maybe sometime next year.
We'll tell them now. Number one, buy Bitcoin.
Buy a Bitcoin.
No, not a Bitcoin. Buy as much Bitcoin as you can.
Mm-hmm.
Not I'll buy some when it drops. You got to have Bitcoin.
Okay.
Not an ETF, the actual thing. Start dollar cost averaging today and continue until you don't have the problem of dollar cost averaging anymore, which in this case is a lot of money, but dollar cost average all the way up until you hold an entire Bitcoin.
Until you hold an entire Bitcoin. But then to your point, exactly, it's just going to continue to go up, right?
Maybe.
But what does that mean to me if it's just going up and I'm just holding it?
Oh,
it's like a home. No, I'm saying it's like a home. People are going to be so afraid to get rid of it and sell it, right? And I'm not saying that doesn't mean you shouldn't invest in it. I agree with you. I'm to the point now where it's like, okay, something as stable as Bitcoin, right? Okay. Not these other meme coins.
Let's just walk through a scenario outside of the show notes here. Would you not argue that politically we're in an unstable world now relative to where we were historically?
100%.
Okay.
Look over, yeah. 100%.
Bitcoin held in a wallet that's not in an ETF, that's literally in a traditional crypto wallet, is probably your safest place to put money with that volatility in the rearview mirror.
Okay.
That's just a fear you got to accept.
Mm-hmm.
The political world is a weird one these days, and we're seeing all this volatility internationally. Having a Bitcoin wallet is decentralized to politics for now. Okay. Number two, you can be an accelerationist here. I started this segment just so you guys recall asking you both if you believed in technology. You said yes.
Yeah.
I said you believe it's increasing at a faster cadence. You said yes.
I do. Yeah.
I asked you both, is it leading the way? You said yes, and it's going faster than it ever has historical. True or fact?
Fact.
Okay.
True or fact? Yeah.
True, historically, truth, whatever. You get what I'm saying.
Yes or yes.
Yes or yes.
Yeah.
Yes. Okay. So we know this to be the truth. Damn it. So excited to make a point, I can't even do it.
All right.
We know this to be the truth. So it is a natural, logical conclusion to come to that Bitcoin as a way to pay for things will be more utilized in the future than less. That is a safe wager. Now, I'm not saying it's 100%, but I'm saying if you're looking at where technology is going, how disrupted politics have become. I mean, you got a guy, Mondani, in New York who ran on socialist idealism because people are so discouraged with capitalism.
Yeah.
Fine. Let's remove the politics from this conversation. Internationally, you've got just disrupted politics everywhere because there's corruption everywhere, like it or not. Crypto seems to be the mechanism with which you're going to pay for things in this accelerated technological world, and you can do it regardless of where you are in it. That's a harsh truth.
It is.
Bitcoin may be the way to do that. Crypto in general may be the way to do that. I'm not saying go out and buy meme coins. I'm saying a decentralized currency held in a wallet is a good investment today. Like that or not, wet paper hand towels. Towel hands, damn it.
White paper towel hands.
Too much caffeine today, boys.
Yeah.
Number two, the more sound advice, sell the S&P 500, buy QQQ. Yeah. S&P 500 is 493 companies, barely keeping up with inflation, dragging down the 7 that actually make the returns. But the index still gives you many benefits. You don't have to monitor changes. You don't have to pay capital gain taxes from rebalancing, and you need less money to diversify properly. What is your second best option? Replace the 500 companies from the New York Stock Exchange with the 100 tech stocks from the NASDAQ, which is the QQQ. You'll get less of the drag and closer to what matters. If you buy VOO or SPY, buy QQQ instead. Today, currently priced at $600.41.
Mm-hmm.
QQQ and Bitcoin are the new 60/40, a sample asymmetric portfolio for the acceleration era. It also aligns with Jeff Park's Radical Portfolio Theory, another book you should possibly read, and in fact is a minimalist radical portfolio.
That I already do. I already do invest in the QQQ.
This is the only defensible strategy about technological acceleration. Own as much of it as you can. It's real. I just dropped my equivalent of a mic, which is my phone.
Look, I'm not saying I'm not on board. I'm on board. Look.
You don't sound like Regil. Does he sound like he's on board?
Yeah. I'm doing notes right now. Invest in QQ.
He's like, I'm on board with this episode. Let's go.
How do you spell that again?
Yeah. No, man. Look, at the end of the day, this thing is gonna go as far as people want to push it to go. I'm against all the meme stock, all the meme coins, right? Something as stable as Bitcoin, yeah, I agree. There's enough people behind it.
Oh, you say as stable as Bitcoin? Look at you adopting.
It's been. You can agree though. You too saw the volatility,
100%, yeah.
Right? And it's like, okay, it's to the point now where there's been enough established to where it's given it legitimacy in areas where you're like, there's an ETF backing it.
It scared me. 100% it did.
Mm-hmm.
But you know what also scared me?
I thought it was gonna be the greatest rug pull of all time.
Eating fat. Eating fat scared me. Oh, I can eat this and lose weight? No way.
Well, because it's completely it's a fiat currency, right? It's completely tied to, is there faith behind this? Do enough people believe in this?
No, I get it.
That's all that it is.
As of right now, there are.
Yeah. And I don't. You're right. I don't see that going away.
Yeah. There's too much institutional buy-in now. There's too much of a back end. So
you got me. Yeah, you got me. Yahtzee.
Yeah.
Next episode, I'm coming in Bitcoin gear. Bitcoin tat on my neck.
Get up on the right side so the camera can see.
Yeah. Oh,
instead of a tattooed tear, he's gonna have a crypto sign.
Yeah, that's a controversial episode for everybody. They're gonna be like, "Oh, these guys look at them."
Bunch of hypocritical liars.
Yeah.
Someone for sure is gonna go back to like episode 4 and be like, "Hey, look what you said here."
Hey, look, we're adapting and we're evolving. Are we not allowed to evolve and adapt? I don't understand.
It is the higher standard, as in continuing to increase.
There you go.
Yeah.
Right. And we didn't say we were already at the highest level.
I mean, one of us is. Regil, it's you, not me. Yeah.
Hey.
The guy in the production suite.
So seriously, what's the name of your house?
Yeah.
I'm just curious.
Listen, guys, if you enjoy the show, please take a second to like it, share it with a friend, or leave us a review. If it's a review, you better make sure it's an honest 5-star review.
Aren't you forgetting something?
What?
Really?
What?
Merry Christmas and Happy Holidays, everybody. We appreciate you tuning in.
I should have started at the top of the show. This was our Christmas episode.
It is. Not was. Is
Where's your
our
Santa,
Christmas episode.
where's your Santa hat?
Bro, I don't have enough hair to hold one of those up anymore. Regil, why you laugh, dog? That's hurtful.
You do have like a small head, though. What's your hat size?
Is that supposed to be? I'm not telling you.
What's your hat size?
It's very private. I'm going to tell you my size of everything else.
Everything else? You do look like you have a small head, though.
7 3/8.
Okay, 7 5/8.
But don't do the hat size comparison.
That's it.
How big are your hands?
Yeah. Big enough.
Regil, what size hat do you wear? I know it's a big ass one.
I think it was 7 1/4. That was back in high school, though. Those
Got both
2
y'all.
8s. 2 8s, 3 8s, 5 8s.
Let's go. All right. So Merry Christmas, everybody. I hope you enjoy your holidays. I hope you're enjoying your time with your families. We sincerely appreciate every single one of you guys. You got anything for the listeners?
No, I just very much appreciate you guys. And Sight is very apologetic for stuttering when he said sincerely.
Sincerely. If you enjoy the show, please take a second to like and share it with a friend. It does a lot for the show. Leave us an honest 5-star review, whether that's on Apple or Spotify. If it's honest and it's 5 stars, we will read it on the show. If it's not, we're going to try to encourage you and plead our case why you should change it. We've been successful twice.
We will harass you.
We will come after you.
Harassment is a form of love.
We will find you.
Yeah.
Right. It helps more people to find the show and allows us to keep bringing you better content. Also, there's a lot of work that goes into the newsletter. Go over and subscribe to the newsletter.
I haven't sent it out in the last couple weeks.
It's a nice recap of the show, and you get a lot more stuff that we don't actually cover on the mic. So if you can, head over to the Higher Standard podcast.com. And actually, it's higherstandardpodcast.com, not the higherstandardpodcast.com.
That's right.
And make sure you subscribe to the newsletter. We appreciate you guys greatly. Regil, you got anything?
Happy holidays, everyone.
Happy holidays.
That's right.
Good man right there. Inclusive. All the peoples.
All the peoples worldwide.
Yeah, everybody.
Everybody.
All the races.
All Ooh.
All the races. What's wrong with that?
like-
Anytime, look, you like to
You're
pay
talking
me.
about sprinting, right?
No,
all the sprinting.
No, this one is all the ethnicities, all
Okay.
the races.
I will just nod my head in affirmation that you made a statement.
There you go.
I am nodding my head.
Okay. All right. We got another episode to do.
Get saying bye.
Okay. Good night, everybody.
Okay, bye.